I want to dig more into what market forces are in play right now, though, as we did get the update not just from Jay Powell, but also from the Trump administration, considering that $1 trillion infrastructure package, which could potentially also come on whatever next wave of stimulus tied specifically to the coronavirus that Republicans and Democrats could agree to. So is now officially a full wave of support underway. Here to discuss that, I want to bring on Milton Ezrati. He's a Wall Street veteran and vested chief economist and author as well. And thank you for chatting with us today, sir. When we look at this, what's your take on maybe the way that the market could now be factoring in not only an accommodative Fed, but now also an additional $1 trillion infrastructure spending bill if Trump's able to get that through?
Well, I think the market was, the market was put off a little bit by Powell's putting a damper on some of the overstated statistics we've been getting. But I think the market was delighted that the Fed promised to continue to support things and asked for fiscal support. And effectively, the Trump administration responded, although it wasn't an immediate response. The Trump administration talked about this infrastructure spending. I think the market realizes that the infrastructure answer is not going to help the immediate recovery from this coronavirus lockdowns and the quarantines. It does have long-term implications, very favorable long-term implications, and I think the market likes that as well.
Yeah, I mean, the long-term implications are certainly there, and you can think about how delayed even the more pressing stimulus bill that came through in regards to coronavirus stimulus checks taking time to get out to Americans and then also be spent. But when you look at that, we did see a very strong retail sales report for the month of May today, as I noted off the top of the show, twice as strong as economists had been bracing for. What does that say to you maybe about the potential and the strength of the idea that we will see a strengthening V-shaped recovery as we move along further in 2020?
Well, I think we're going to see a V initially, but then we're going to have to deal with the lingering effects of fear, the lingering effects of the bankruptcies that have already occurred. And I think this gets to Chairman Powell's remarks about inequality. The companies that failed in this quarantine lockdown period were the smaller, less well-capitalized companies, and they tended to be clustered in some of the poorer neighborhoods and among the most disadvantaged parts of the population. So what Powell's talking about is getting us back to the point where we had such wonderfully high low unemployment, high employment numbers for minority groups. He says that's not going to happen for a long time, and I think he's right. There have been a lot of bankruptcies in this area, and they don't come back. But we will see when the public is going to spring back because they want to get out, they want to have a nice meal, they want to go to the bar, they want to see their friends, and they want to buy things other than groceries, which well, for being held up in the house. But but that may fade. So what I think Powell's worried about is we'll get a V and then a hesitation, and I think he's guarding against that.
Milton, it's Brian Chung here. So it seems like the corporate bond purchases were something that were really in focus, especially with the Fed's announcement yesterday. It seems like equities had quite the rise on that, even though it's specifically targeting investment grade, some junk bond corporate debt. I'm wondering how you think that has played into the market dynamics today. And there's been some debate about whether or not the Fed is intervening too much or if it's doing just enough to make sure the market is functioning properly. What's your viewpoint based on the dynamics that you've seen over the past few weeks?
Well, I think the market is delighted that the Fed is putting in liquidity, and the fact that the Fed is considering and buying individual bonds, or at least packages of individual bonds instead of a broad index, means that the money presumably would be going to where it's needed. The market likes that. What the market will hesitate to is that the Fed is picking winners and losers, effectively saying we're going to help this company, we're not going to help that company, and that I think is not going to go well in the market.
Yeah, and lastly, I mean, when we look at this, you do talk about Americans wanting to spend beyond just going to food stores. We did see strength in the May report on that front, as well as non-retail stores. E-commerce still very strong relative to beyond or before the pandemic hit. But beyond that, I mean, you look at apparel still down 63 points in May. You still look at other pain here. Restaurant and bars showing a slight recovery, but still down 40% since February. So, I mean, when you look at it, I understand that it does seem like the trend is turning, but what insight do you get from this report, or maybe other reports we've gotten so far, in regards to what thing or the pace of recovery beyond just this quick change in trend?
Well, I think that you're quite right to look at the detail. There has been the comeback in autos, in furniture. You pointed out apparel. These are areas where people can postpone their purchases. So effectively, they're just they're just beginning to take advantage of the reopening, and they're delighted to get out. But we are not seeing a broad-based recovery in retail sales, and it's important to realize that just about everything is down from where it was before the lockdowns and the quarantines, even food at home.
Yeah, we'll see if the trends continue as we get these reports. Obviously, one report does not make a trend. We'll see if strength continues. And the next one as well. But Milton Ezrati, Wall Street veteran, investor, chief economist, appreciate you taking the time.
Thank you.